We have goods valued at 210 million foreign, and we are giving 3 months credit. Okay. We don't have any bid or ask, unlike question 5, but I could have that in here as well. I just give the spot price. Let's assume there's a bid and ask price here. We'll say it's 306 and there's a 308 bid and ask. As an exporter, what would you go with, the bid or the ask rate?
Ask.
Yeah. Do you remember yesterday I shortened it, even if you don't want to think of EA Sports, exporter, the ask. Okay. Let's recap on that just in case you don't know why it's the ask or the offer rate. If you're exporting goods, you are going to receive foreign. You don't want Hungarian foreign. What you want is euro, which is your home currency. You're based in France. This company is French. Okay, so they're euro. And so you are going to sell the foreign to buy the home currency. Customer uses the bid to sell the home currency. Customer uses the offer, or customer uses the ask to buy the home currency. And that's why we're using the ask rate. Okay, so just in case that comes up also in this question, it'll be the ask rate. So anyway, there's your spot, or if it was an ask. We have futures information, June or September. We are also going to be looking at options. Okay, and looking ahead at the question, we want to find out what your outcome is using futures. Yeah, just futures. So the first one is what your option is, or what your outcome is regarding futures, your net trading position, and your hedge efficiency. So there's a number of things going on in here. Okay, I'm just going to highlight those few parts and maybe read it a little bit better. Show how you could hedge using futures. Okay, so that's one. Calculate its net trading position. Great. And calculate the hedge efficiency. There's 3 parts there to that question. Okay, the biggest one is the one highlighted in blue. Okay, and we have to do that twice. Remember, we do it for the exporter, then we do it all again for the importer. So here's a little bit of information that I tend to write out. I have it in italics here on all my solutions, and I did it in class as well. So we want to find out what we're actually doing, and therefore this is going to help us establish whether we're going to be buying futures contracts or selling futures contracts, just like the way we established with the exporter and the importer, whether we're going to be using the bid or the offer rate regarding the spots. So the same thinking goes on. What are you doing with the foreign, and what are you doing with your home currency? And this we already established with the spot rate. So with the exporter, when we did it for the establishing whether we did a bid or the offer rate, same goes for futures and the same goes for options. So we exported goods, meaning we're going to receive Hungarian foreign. Therefore, you're going to sell that Hungarian foreign and you are buying euro. Euro is your home currency, but don't think of that, okay? That only comes into account when you're looking at the bid and ask rate, because the customer uses the bid to sell the home currency, customer uses the ask to buy the home currency. That's why we chose the ask or the offer rate. In this case with the futures, we are dealing with identifying whether we should be buying or selling futures. So we have to then look at what's called the underlying contract. Okay, so the underlying is what you are going to be trading in terms of the contracts. So say, for example, the oil futures, the underlying is your barrels of oil. With gold, it's ounces of gold. And with exchange rates, or it could be, in this case, it's going to be in euro. It could be in dollars, it could be in sterling. We're always going to have the underlying as a home currency. So because you were, and I'll just jump back up to the question, I might have it here actually in the solution anyway. So if we look at the actual question again, so you understand where it's coming from, and I'm going to highlight it in red. If you see the futures contracts here, foreign and dollar, this is the underlying. Contract sizes are 125,000 euro. Okay, and because you are an exporter, you are receiving Hungarian foreign, you sell the foreign, you buy the euro, your Contract sizes are in euro, therefore you are going to be buying futures. Therefore, you buy futures. But what futures? Okay. I jumped ahead there with September. Are we going to choose June or September? You know it's September. Well, I think it's right anyway. We'll check. Or which one would it be? June or September? We need to go back to all the yellow I've highlighted. It's no. I should have actually highlighted this as well. June is too early, go on. Yeah, so it's April. We've given 3 months credit. It's highlighted in yellow. So the 9th of April to the 9th of May to the 9th of June is only 2 months. If we take out a June futures contract, that's going to expire in June. We want to have that running for at least another month. Okay, so we want to run until the end of July. A July contract is not available. Okay, the next available contract is September, and that's what we're going to go with. If I had a third one in there, if I had June, a September, and a December contract, which one would you go with? You go with September. If you choose December in your exam question, that's perfectly fine as well. Okay, a December contract because it's still available. When you close out your July contract and you ended up having bought a December futures, that's still fine. You're still going to be able to close that out. The thing is, it's going to be a little bit more expensive. You see here, look at the prices are changing, maybe for the better or the worse. But if you think of a physical commodity like gold, you'd expect because of the cost of carry, a December contract is going to be more expensive. So why would you put that expense on you when you're going to close out early in July? It's like you going out and taking out insurance and going on a holiday for a week, but you decide to take out insurance for a year and it's not necessary at all. Okay, so you'd be better off just going with the September, but there's nothing wrong with going with a December contract. Okay, and that's why in the solution, I have September contract highlighted. All right, so that's just, this is what we're doing here. I know I spent quite a bit of time on it, and all it is just one quick sentence, but I've emphasized it in class as well, and I can't emphasize it enough. This is key for your unlocking the solution that you're going to do. So understanding all of that, and even if you don't understand it, just remember the exporter will buy futures. Now that we've established this, we can really move on quickly. Okay, so how many contracts do we need to buy? Sorry for jumping ahead. We're here with the answer, but I'll just go through it. If you recall, we were exported goods to the value of 210 million Hungarian forint. Okay, so that's where we're getting this from, what I highlighted earlier on in the exam paper. We're going to divide that by the 3469. Again, let's find out where this figure is coming from, because already we've only highlighted and identified a spot price. Do you think this is a spot price, or do you think this is a futures price?
Is that futures price?
Why is it a futures price?
Because you're buying the futures contracts.
Yeah, so we're in the futures right now, so please don't use a spot price. Again, this is a note you might like to take down. When you're calculating the number of contracts, always use the futures price. In this case, it's the September's futures price. Some people put in the spot price there. You're going to get the same answer anyway. Chances are you're going to get 5 contracts, but you're using the wrong exchange. So again, I'm going to show you where this is coming from. In the question, we've highlighted a spot, it's 307. We're not dividing the 210, there's the 210 million forint. We're actually using the September futures price there. Okay, that's what we're dividing into, the 312. This will get us the number of contracts. So 210 divided by that, 312. Hopefully this is correct. So if you have a calculator, you can help work through this with me. 672,000 euro. So we've converted it into euro. The contract size is in euro. That's why we have to convert this. Please don't come along and divide the contract size into 210 million forint, because you're creating an exchange. You convert this out into euro. Now you have a common currency that you're working with. Divide a contract size into that. And if this is correct, 5.38 contracts. And you can round that up or down. There's no part contracts available in the futures exchange. So I'm happy for you to go with 6 contracts here as well. You're just going to be slightly over leveraged or over covered. If you go with 6, and in my case, because I went down to 5, I'm exposing myself to a little bit of risk just in case, you know, it might go against me. All right, so that's straightforward enough. We'll actually see that calculation again when you were dealing with the importer. Okay, regarding the futures market, this is a setup. You don't have to follow exactly what I have here. Okay, you can just do your own quick calculation. But I divided up into and in class I would have called this the cash market and the futures market, and spot is perfectly fine because we're using spots. So on the 9th of April, when we decided to send out this invoice or the goods that were purchased from us, we have a target, what's called a target here, and based on the spot price that we actually had highlighted, the 307. And we're saying that, like in the previous question 5, if our customer gave us the money today, in other words, if there was a lead payment, what would we have received if that lead payment was activated? Well, if based on the current spot rate, we would receive 683,099 euro. Okay, but that's not going to happen. They're not going to give us any money today. So let's not worry about the futures just yet. Let's fast forward then. So when we're due payment on the 9th of, what actually happens is we received the same 210 million forint, but the exchange rate changed. Now here we have a new figure, 328.4656. Where's that coming from? Well, I should tell you in the exam question that in 3 months' time or whatever it is, the spot rate will have changed to 328. And I will also say that the futures price will have changed by whatever. Okay, and I'm just going to go back into the question to show you where that's coming from. Right underneath here. It says here, assume that by the invoice due date, spot prices have moved to 328.4656. And that's what I use also in the cash market or the spot market. So here's the spot price first, 307. Here's our second one. That was our target. This is what actually happens. And we will see whether we ended up with more or with less if there was no hedging taking place. So at 328, we actually received 639,000, which is, it's not a loss, okay, because we didn't lose out, but based on the exchange rate, it's seen maybe as a paper loss of about just under 44,000 euro. So because we decided at the time to hedge, we should be able to recover some of that. We are hoping for a perfect hedge, but we know we're not going to get a perfect hedge. Can anyone tell me why we're not going to get a perfect hedge? It's based on a previous calculation up here.
We only have 5 contracts.
We only have 5 contracts. If I was able to do part contracts of 5.38, I should be able to offset that loss of 44,000 with a gain of 44,000. So those of you who decided to round up to 6 will have actually made a larger gain than what I'm going to show right here. So let's look at what happened in the futures market. So reverse back in time on the 9th of April, when the invoice was sent out for payment along with the goods, and we were giving 3 months credit, we decided, just in case the exchange rate went against us, to buy September futures. And we bought 5 of them. Each contract has a value of 125,000, okay? And we are also told that the September futures was 312 euro. I don't have to jump into the question to show you that, do I?
No.
Right, so that's fine. And we just multiply all that out. Notice we have euro here. Now we have this exchange rate forint to euro. So effectively what we're doing is 5 by 125 is 625,000 euro. But we have to convert it because we're buying these forint futures. And it's always important, I think anyway, to put down your symbol, the currency. Then we fast forward on the 9th of September. I have sell here. Why am I selling futures on the 9th?
Because you've no use for them anymore.
Yeah. The futures are no good to me now. I want to close out on the 9th of September. Sorry, this is July, isn't it? Just by the way, because it was 3 months credit given. So we're closing out on the 9th of July, I think. April, May, June, July. Yeah, so they're the 9th of July. But yeah, we've no use for them anymore. These September futures contracts. If that's confusing, I hope it's not. But we bought September futures and we're closing out in July. If you buy something and you want to close it out, you have to sell it. If you sell it initially, you have to buy it back. So that's why we have initially buy and then we have sell. And you also have to do the same. You have to close out your 5. The contract size are standardized. They will always remain at 125,000 euro unless something drastically happens. But what changes is the futures price. And we were told underneath that table where you had the futures prices, along with the new spot price, the futures prices changed to 326. And notice, look up here where we have the spot and the new spot price. The figure looks as if it's gone higher. I just used that. And the futures should also move in the same direction as the spot price. So when we work this out, we have this 204 million Hungarian forint. You take the difference, which is a gain of 8.82. So it's like as if you bought at 195, sold out at a higher price, giving you an 8.8 million Hungarian forint gain. But we need to convert this because we're expressing it all in, we want to express everything in our home currency, euro. That's why I said always put in the foreign currency here, just in case some people leave it at that. So we need to convert it at, now, what are we converting it at? Is this 328 a futures price or a spot price?
Spot.
All right. So remember, we sold our futures because we don't need them anymore. Therefore, futures markets are all over. We took our gain of 8.8 million. And now what we do is with that Hungarian forint, we convert it at the spot. And notice here, look at this is the spot price, what actually is on the 9th of July. There we see it again. And we have a 26 and just under 27,000 euro gain. Okay, so there's another note for you to jot down. When you're dealing with the futures market, if there's a gain or a loss, it's in the foreign currency, you need to convert it at the current spot price. Okay, so now we need to identify the net receipt. Okay, the net receipt is going to be, you see I have only 2 figures in here, 2 figures. This 639,000 is coming from your actual. Okay, 639. You have a gain of 26,000, which is down here. Should we add it on or take it away?
Should you add it on because it's a profit you made on the future?
Yeah. So let me explain this. Okay, because we want to head towards our target price, in this case 683, and because you ended up with an actual which was less, you should add this on and you're trying to hedge, so you're trying to make ground and have your gain or your receipts near enough to the 683. If it was a perfect hedge, you'd get this figure again. So I should actually have this added on. So I'd appreciate if someone could jump in and do a quick addition here while I explain something else, if it's okay with you. Another thing is you might be confused with is why am I adding the gain, but the loss isn't featuring in the calculation here. The reason why I don't have the loss featured here is because I've just taken the actual of the 639. So in a way, that's already taken into account the loss of 43,763. I could have also had this, I could have put this figure in instead, 683. Then I would reduce by the loss of 43,000, and then I would add on the gain of 26,858. So I could do it that way, but look, I already have this done. It's already done. What does that work out at if someone has that?
666,194.95.
0.95. Okay. Let's price of Bitcoin next year. Right. Again, let's jump into the question because I want to make sure I'm covering all these parts. So assume, right, where are we? Okay. Show how they could hedge their exposure using futures. Okay, so we've showed that regarding the spot and the futures market. We've just calculated the net trading position, and now we have to calculate the hedge efficiency. So we showed how it's done, how hedging is done with the contract size, all of this. There's your net trading position, and now the hedge efficiency. The hedge efficiency is just simply your gain over your loss. So make sure you know that. So you have your gain 26,000 over your loss of 43,000 by 100%. And that's giving me only a 61.37% hedge efficiency. Ideally, I'd want 100%. If someone had chosen 6 contracts, you might have something like 120% hedge efficiency, which worked out for you at that point.